When you hear the words investment strategy, what do you think of? Some people may say growth investing, or income investing, or dollar cost averaging, day trading, dividend growth, momentum. Since the inception of the stock market, there have been endless investment methods and strategies, which both institutional and retail investors use and swear by. All of these methods have their own benefits and risks. However, over time, one investment strategy has outperformed the rest massively, and is the clear winner when it comes to achieving the real goals of any serious investor: long-term substantial gains and minimal losses. Value investing, the most successful investment strategy in history, was created by the legendary investor Benjamin Graham. Graham was a great man who hoped that small retail investors could one day go toe-to-toe with large institutional investors. He also proved that an extremely high IQ was not a requisite for great financial decision-making. His teachings and investment strategies were elucidated in his best-selling book, The Intelligent Investor. Graham's teachings have transformed the idea of what it means to be an investor, and some of the most successful investors on earth have followed his principles throughout their lives. The most famous of these is Warren Buffett, arguably the most successful investor of all time. Buffett wrote about The Intelligent Investor. I read the first edition of this book early in 1950, when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is. To me, Ben Graham was far more than an author or a teacher. More than any other man except my father, he influenced my life. So what are the key principles of value investing? And how can we apply it to our own investment choices in order to reap the rewards while also reducing our risk of losses? In this video, we will find out the 3 golden rules of value investing according to Benjamin Graham. Make sure to watch till the end of the video, as these 3 simple rules could change your financial future and set you on a path towards achieving your financial goals in life. So let's get into it. Rule number 1. Always ask, how much? One of Graham's famous sayings was, pick your stocks like groceries, not like perfumes. When you go to do your weekly shopping, do you buy the most expensive items? Do you look at the price of a certain food from one week to the next and decide whether to buy it based on the change in price? Do you ever purchase a new product without checking the price? The answers to all these questions are obviously no. Almost everyone analyzes their grocery shopping in order to find the best food for the best possible price, or in other words, get the best value. Unfortunately, the majority of people do not apply these principles when spending hundreds or thousands of their hard-earned cash on their investments. Many people simply let charts, rumors, or news stories influence their money decisions, and therefore take on a huge amount of risk. Graham implores everyone to remember that when you buy a stock, you are actually buying a part of a real company, not just a ticker symbol, and will have access to a share of that company's profits. If you pay too much for the stake in the company, then you have not made a good value investment, and therefore increase your risk of losses. Making good value investments require you to analyze a company's real value at this moment in time, and judge whether the price you are paying for the share in it is a fair price, or hopefully undervalued. Graham says that some of the worst losses happen when investors forget to ask, how much? As an investor, you should never take a share price for granted. Do your own research and decide for yourself whether what you are paying for it is really worth it. If you are new to investing and are not sure how to do this, you may want to try to learn some basic accounting, including how to read some key financial documents and a company's balance sheet, so that you can really understand the performance of the business over time and get an idea of its real value. This may take some time to learn, but it will be worth it in the long run. By developing your business valuation skills, you can learn which businesses are worth the price they are charging, which is essential to value investing. Rule number 2. Speculation is not the same as investment. As time passes, it is becoming more and more common to see people around the world investing in the stock market. Trading platforms accessible on the phone are becoming universal, and the number of investors is only increasing every year. However, according to Graham, very few of these people are actually investing their money. In reality, the majority of people are just speculating. Unfortunately, very few people know the difference between the two terms, and as a result are taking on far more risk than any long-term investor ever should. Graham says that speculation is when you purchase a stock because you believe that someone will pay more for it in the future. You may think that this is the definition of investment. However, if you think that way, then you are already taking a risky path with your money. Buying something purely because you think you can sell it for more later is speculation, not investment. Although it is necessary, exciting, and can lead to handsome profits, it also carries a large amount of risk with it and is not a viable strategy for long-term consistent returns. Graham says that if you want to speculate, you should do it intelligently. This means allocating small amounts of money to a specific speculation account and not mixing it up with your proper investments. It is also extremely important to know that you are speculating, or essentially gambling at the casino. Speculators should never get emotionally attached to their stock picks, or think that they are a genius if they make a profit. It is best to treat it as gambling, with very little difference to picking different numbers at the roulette table. On the other hand, Graham's definition of investing could not be clearer. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. The two key principles of investing, therefore, are to get adequate, not extraordinary, returns over the long term, while minimizing the chance of losing any of your initial investment. The main ways of doing this are to invest in safe companies at a good price, which will pay dividends, or purchase bonds in safe companies and public institutions. These two strategies should allow you to receive an adequate income greater than what you can get in a regular savings account, while at the same time not losing your money. If you have paid the right price for the share, then it is likely that you will also be able to profit when selling it. However, this is secondary to the main concept. The hardest part of real investing is analyzing whether a company is stable enough to be invested in and whether you are paying the right price. For this reason, it can be much more beneficial to invest in bonds. However, if this is done well, the risk of losing your money is greatly reduced and income streams can be more than adequate. Remember, the intelligent investor keeps their money and doesn't lose it. Rule number 3. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. This rule is one of Graham's most insightful observations and is usually only learned by most investors after years of experience in the market. Logically, most people would think that if a business is obviously going to make some significant profits in the near future, it would be a good idea to buy some shares in the company and watch the price rise. However, this is not the case. The fact that a company is obviously in a good position now means that other investors will already have the same opinion as you. The likelihood is that other investors have already bought shares in that same company and have bid up the price to extremely high levels. At this point, the risk of the price falling has become much larger, and extreme care needs to be taken when choosing whether to purchase shares or not. Many investors have lost money on investments in successful companies. The problem is not the company itself, just the timing of the investment and the price paid. Graham advocates that investors should look for companies which have strong prospects for future profits, but are not being looked at by the entire market. This is harder said than done, but it does reduce the risk substantially. There is much more to learn about value investing. However, if you apply these 3 simple rules now, it could give you a much more stable financial base in which to operate. It is essential for all investors to take the advice of Benjamin Graham, so that you can all make much more intelligent financial decisions. If you like this type of content and would like to know more about how to build wealth in the coming future, make sure to subscribe to the T15 report. If you know anyone who would like this video, then please share it with them. Alright guys, thanks so much for watching, and I'll see you on the next one.